In this video, I'm going to talk about how long the IRS has to collect money from you. Now, there are two relevant statutes of limitations here. In a previous video, I talked about how the IRS generally has 3 years to assess tax on a taxpayer. There were examples where it could be 6 years, or in some cases there would be no statute of limitations. For example, if the taxpayer hadn't filed a tax return or if they had filed a fraudulent tax return. So we've talked about the restrictions on the IRS's ability to assess tax. Now, assessing tax is different from the IRS collecting those taxes from the taxpayer, and collecting tax is what we're going to be talking about in this video. So once the IRS has assessed the tax and says, look, this taxpayer owes $70,000, for example, then the IRS typically has 10 years from the date of the assessment to collect that tax. Okay, now there are certain examples where that 10-year period could be pushed out or it could be put on pause. But the good news is, for a taxpayer, the IRS can't come after you forever. So let's get into this. We'll start with the basics. So section 6502A1 of the tax code says the IRS can collect unpaid taxes within 10 years after the assessment of the tax. So the key is that there has to be a tax assessment first. Once the IRS has said, look, you owe this amount of money, then the 10-year clock begins. Now, after the 10 years, the debt is forgiven. The IRS cannot collect the debt. So we're talking here about the debt taxes, interest, penalties. So you've got 10 years after the assessment, 10 years after that, now the taxpayer is in the clear and doesn't have to pay any remaining amounts to the IRS. Now, the IRS is going to fight hard during that time period, right? They will seize property of the taxpayer, garnish wages, and do everything. So it's not a simple thing where you say, well, I'll just wait around and I won't have to pay the IRS. Okay. Now, let's say that Tom has been assessed a $50,000 tax deficiency and that the assessment date is July 1st, 2025. So if that's the date that the tax was assessed, then the IRS basically has 10 years from that date to do levies, which is seizing property, garnish Tom's wages, whatever, to get that money. Okay, so the clock starts ticking when the tax is assessed. Okay, you have that 10-year clock. Now, I said that there were exceptions in cases where it could be extended or in some cases paused, which we call suspended. So let's talk about extensions first. Now, if the taxpayer agrees to an extension as part of an installment agreement, then it could go beyond 10 years. Now, you might say, well, why would a taxpayer ever agree for it to go beyond the 10 years? Well, if you say, look, I don't have all the money to pay, it would actually be more convenient for me if we worked out an installment agreement. And then the IRS say, okay, we can work that out. But in some cases, if it goes beyond 10 years, that might result for the taxpayer in having lower payments that are easier for them to bear. But if they agree to that, extension, then they can't come later and say, hey, there was a 10-year period and it's beyond that. I don't owe you the money anymore. Okay. Now, also the IRS can successfully, if they are able to successfully get a court order extending the period. So they could ask a court to give it more time to get the money. Okay, court could say yes, court could say no, but if the IRS is successful in getting the court order, that could extend and push out that 10-year period, so it's longer than 10 years. Now, in some cases, that 10-year period can be suspended. So extension, think about extension as pushing out the 10-year period, so it's like 11 years or it's 12 years instead of 10. Suspension is we're putting it on pause. Okay, so we're saying, okay, you know what? Instead, the clock is not going to start ticking yet. Now, what would cause a suspension? Either way, it's going to delay. So basically, during a suspension, the IRS isn't going to be seizing property and stuff like that. Generally, they're generally not able to do that. For example, if the taxpayer were to file for bankruptcy, then generally the IRS has to just kind of lay off until this is resolved. Okay, if the taxpayer files a request for innocent spouse relief, I can make another video on that. Innocent spouse relief is basically you have two spouses, they file a joint return. Maybe one of the spouses committed tax fraud. The other spouse didn't know about that. And generally, you're responsible. If you file a joint return, you're both responsible for that debt, that tax. But if the spouse could say, hey, I'm an innocent spouse, I didn't know about this tax fraud, I pursued a divorce since that time, I don't have the money, etc. There have been tax cases where people got this innocent spouse relief. So if you file a request for innocent spouse relief, that puts it on hold, the 10-year period. If the taxpayer submits an offer in compromise, that's where you're asking an offer in compromise, and I'll make a video on that, where you're basically asking the IRS to accept less money than what the actual tax debt is. So again, these things are all going to put on hold. They're going to pause that 10-year collection period. Okay, if the taxpayer requests a collection due process hearing, if they're in the military and they enter a combat zone, or if the taxpayer lives outside the U.S. for a period of longer than 6 months. Okay, so you're not going to be able to get out of this 10-year period by just skipping the country and saying, you don't want to guess, I'll just hang out in Tahiti for 10 years. Now, what if the taxpayer doesn't file a tax return? Because some people might think, well, can I just get out of this if I don't even file a tax return? Well, if you don't file a tax return, what's going to happen is the IRS will file a tax return for you. It's called substitute for return. So the IRS will file a substitute for return and then go ahead and assess the tax due. So you don't file a return, they file a return for you and then say, okay, here's the amount of tax that's owed, let's say $80,000 or whatever. And at that point, the 10-year collection period will begin. So again, the 10-year collection period always begins as of the date of assessment. So in this case, just a key takeaway, not filing a tax return is not going to prevent the IRS from assessing tax or from collecting back taxes from you.